2015. We'll go through standard weather, gas pricing, the LNP clears in the day ahead that we've seen over New England side, and the impact of the global LNG and oil prices and winter availability and just oil and LNGs on New England market. Afterwards, we'll just jump into spring expectations for 2015. Just our outlook on demand and temperatures, precipitation, any generation transmission analysis, outages that we anticipate, imports, exports, and any retirements or what changes we are seeing this spring versus last spring with the Vermont Yankee outage. So let's just quickly recap winter 2014-2015. So December was pretty much mild with the start. We saw above 1 or 2 degrees above normal temperatures, hence we didn't see much of the volatility over the December month when it came to gas or the mass hub. January 8th started off cold. We reached actually our peak closer to 20.5 gigs on load, and it was an Arctic area that gave Boston a -1 low and 19 high of 19 Fahrenheit. Most of the January was more or less uneventful until we hit February when we saw 3 to 4 degrees cooler temperatures and pretty much a snowstorm for the entire month with a historic snowfall for the month of February. And hence we saw that volatility in gas as well as mass hub pricing closer to February. So as you can see, we have a bit of a spike in December, some of it in January, but it pretty much fluctuated under 15 per TU. And then February and most of the February, we reached our peak gas pricing, I think, closer to $30. Just as a comparison to last year and the year before, I mean, the gas prices we saw this year were not as strong. One of the biggest reasons is definitely the fact that we did not have that polar vortex across the country itself. So PJM, PJM might in New York was cold, but PJM was not cold until closer to the end of February, not as cold. So we didn't see that strong pull on gas as we saw last year. So our highest AGT was $30 February 25th. Peak day head clear was $2.50. That was February 24th with AGT at $28.05. Closer to the end of February, we saw the gas pricing for this year higher than some parts of last year and the year before, and mainly I think it's due to the oil depletion of inventories and the fact that we pretty much had canals stepping out. This is from an NEISO. It's a public info that we grabbed and just showing you the depletion of oil inventories towards the end of the year, the end of the winter, I'm sorry. That resulted in also more volatility for the AGT and less oil in a supply stack. So just to recap, this year versus last year, oil, not only the weather-wise, New England was still cold, despite the fact that the rest of the country wasn't as cold as New England. New England was still cold, but what kept us low is the part of the winter reliability program that was set by the NEISO, the low gas pricing as well as the low oil pricing. So winter reliability for the start of winter, the geofire generation had to be tested. There was incentive for generators to procure oil, and any unburned inventories were to be compensated at $18 per barrel. So that definitely helped those oil units in for the supply stack. What we saw is that oil came on at 18.5 gig load. Big difference between this winter and last winter was that last winter had probably close to $70 per barrel. This winter we're looking at 50. So oil came in closer to probably when gas traded around 12, 13 versus last year at 21. So around $12, $13 oil units became more economic. LNG, major knockoff effect from the oil bust was the drop in LNG pricing. As you can see, Canaport was most attractive price-wise, $16.74 landed January pricing versus your JKM, Japan, Korean market spot pricing over there. Overall, LNG prices fell by 47.3% versus this time February last year. And there's a bunch of factors that go into that besides just oil collapse, just overall lower demand from the Asian markets and lower GDP expected growth. Same incentive was put forward by that. So for LNGs, any unburned was to be compensated by $3 per MMBTU. So how much actually LNGs we got this year? This is LNG sent from Everett and Accelerate to AGT and TGP pipelines. As of February 23rd, this was the last time we looked at the data, was closer to over 12.7 thousand MMCF. Past week or two, we've seen low send-outs from Canaport. Over 10,000 was from Everett, close to 2.7 from Accelerate. However, if you look at the graphic for the past two winters, the send-out from Canaport and other New England LNG terminals have been the lowest compared to the last couple of winters. And the main takeaway from that is that we had a pretty strong, robust domestic supply of gas. And those price blowouts only happen when the system is really constrained. So that's another thing to keep in mind going over to the shoulder months, that the gas prices are most likely expected to be lower this year versus this time last year. So just a quick couple of things to keep in mind going forward. So LNG is a big question if it's going to be part of our winter reliability going forward, since we're not seeing any new pipelines getting built out. The big thing about LNG right now is that it's not going to rebound. If oil rebounds, that LNG won't at the same rate as oil. It's not going to be a V-shaped rebound, and the main reason behind it is that the demand side is not expected to grow as fast, especially on Asian markets. The GDP expectation of growth is lower. The other thing is Australia is actually in process of increasing the supply of LNG and becoming one of the largest exports of LNG in the next 3 years. They'll increase the surge by 34%. So I'm not expecting LNGs to be as higher next winter, coming winter, than what we've seen this winter, just because of extra supply that we're seeing. Oil is definitely the big question on everybody's mind. That's going to make an interesting summer. The main thing is we do have oversupply right now, and until demand aligns with the supply, we'll see those low pricing. The economies of the storage are disappearing past 4 months. Cost of storage jumped by 50%, and a bunch of North American oil production is declining at a faster rate. So just look out for OPEC June 5th meeting to see any updates on that. So, I mean, even if the oil rebounds by next winter at the same level as we saw previous winter, one thing to keep in mind, LNGs are still expected to stay more or less similar year over year at this point. So I'm just going to pass over to Lindsay to touch upon the spring weather and outages.
All right, hi everyone. We're going to start by taking a look at the temperature expectations that we're going to be seeing for the upcoming spring. We've seen fairly cold conditions in the winter, as Natalia discussed. This cold weather is going to linger, particularly in March to begin the spring. This will drive some bullish risk to start the season as we see heating lows lingering into the start of the season. The colder conditions will decrease somewhat as we head into April. Be pretty bearish in April as heating load decreases. We will see the cooler weather return in May. Late in the season, cool conditions don't have as much of an implication. They will, however, reduce the risk of seeing any sort of early cooling load as we start to head into the summer. Risk to this forecast, we are generally relying on the breaking down of a strong ridge in the Pacific. This is what mostly drove those cold conditions we saw this winter. If this ridge does not break down, the cold anomalies can be expected to persist and possibly just keep colder weather even in April and May. Looking at precipitation, not too much here. We are seeing some stronger, some higher than average precip levels, particularly for March. The main implication here is to drive lighting load as we see more cloud cover. This does tend to decrease as the season continues, and we will see those lighting load risks decrease with less precipitation. So the risk to the forecast, again here, related to that strong ridge. The wetter than average conditions can be expected to continue in New England if that ridge doesn't break down. And if the storm track shifts east in April and May, drier than average conditions in the Midwest would extend into New England. The main risk with that is the less lighting load, so it's more of a bearish risk to the forecast. In conclusion, with the summary for the spring weather, the weak El Nino is one of the main drivers for what's going on, as well as that eastern Pacific ridge. The main thing about the weak El Nino is it's basically keeping precipitation south of the region for April and May. We are going to see the colder conditions lingering in March, but increasing heating load, but they will reemerge in May, which will have more of a bearish impact with less cooling load likely. We're now going to move on to the expected outages for spring 2015. There wasn't too much that's significant that we saw. The main thing that we're looking at is a Pilgrim outage. That's beginning April 19th, and historically they have been out for about 25 days. We can expect them to be out for a lot of April and part of May. Pilgrim, as you know, is a 685 megawatt plant. It's located in SEMA, and the closest load centers will be Boston and Providence. Now, we are seeing this outage coincide with the peak outage week of May 9th as given to us by the ISO. And this generally drives a bullish risk just with the outages and a thinner supply stack. And that's our main generator outage. We are going to now move on to transmission outages for the spring. Again, there weren't particularly large amount of these expected. We did have two of note. The first we are looking at is the Maxe's line, 392, and that's out for the bulk of March, beginning March 9th and heading through March 24th. This line tends to drive congestion risk on the Orrington and Seabrook interfaces, which is what we have been seeing in the past couple of days. Now, with strong generation in Maine and imports flowing from New Brunswick, the power flows south towards the load center of Boston area. And we do tend to see a bearish implications for Maine and stronger pricing for Mass Hub with this transmission outage. The second line we did point out is the Kingston Street line. This is located around Mystic. This is going to be out beginning early April and through the end of the May. So it's a pretty long duration outage and basically drives the congestion risk for NEMA and the Mass Hub. This is really relevant, determined if Mystic is running or not. If Mystic does run, this does drive this congestion risk, but we will see less of it if Mystic ends up not running. Finally, we're going to take a look at the tide flows for the spring. We did a bit of historical analysis of the past tide flows we have seen. Our main things that we looked at was Phase 1 and Hydro-Quebec Phase 1 and 2. Those are our, New York and Hydro-Quebec Phase 1 and 2. Those are our main imports. We do see fairly consistent output from Phase 1 and 2, but New York inputs tend to decrease as we enter the cooling season with less power needed from them with milder conditions here than in New York. We do tend to see typically low net imports from New Brunswick, and we have seen the crosstown cable return this past season, but we haven't seen too much action on it, and flows on this are generally small exports to New York. Now, the main difference we're looking at this year is with the loss of Vermont Yankee. This is a generally loss of baseload generation, so we can expect increased flows as we need more power heading into the spring. We're going to give it back to Natalia now to conclude the presentation.
Thanks. So what we did, we grabbed the supply stack from last year and we looked at April. So what we did, we took out, first of all, Pilgrim units with Vermont Yankee. That put us at, with a 15.1 gig load with nat gas at $5 in April last year. That would have given mass hop at 41.83 with heat rate at 8.37. And we took the same supply stack and took the Vermont Yankee out just to show what the difference is between last spring pricing and this spring prices with Vermont Yankee outage and that Pilgrim not in as well. And that increased our mass hop closer to 44.72 with heat rate at 8.94. Having said that, I do want to reiterate that it doesn't mean that this spring we're going to be $3 higher overall. It's just that with two nukes out, considering last year, it will increase the pricing, but we do have gas prices expected this spring probably below $5. So I ran with no Pilgrim and no Vermont Yankee at $3 for nat gas, and that put me at 37.41 with heat rate at 9.35. So yeah, we do have less base load, but going into the spring, we're most likely going to have lower nat gas. So just to conclude factors, demand is neutral. We do, with precipitation this month, there is a risk of lighting load in the real time, so do look out for that. Generation-wise, yes, it's bullish without Vermont Yankee and one big one's Pilgrim. Transmission is bullish. We do anticipate some of that Orrington and Seabrook constraints and possibly NEMA constraints with the Mystic 35 kV line outage. We looked at the type flows. We didn't see any due rates with New York, New England, or with phase 1 and 2. So those are like the big ones that we haven't seen, or New Brunswick either, anything significant. So the transmission outages are within the system itself bullish. Type flows we think will be bearish just because we'll see healthy flows unless there's anything drastic going on. Pre-seasonal, especially with Vermont Yankee outage, we'll probably see them in. And nat gas, just with the robust production and pretty much having USA being Saudi Arabia of gas at this point, we're going to probably be bearish this year versus last year as well. So just overall, more or less bearish outlook going to spring despite Vermont Yankee. I looked at the generation. We don't have anything retiring right now, not even this year. I think we have Brayton retiring June 2017. We have SCC units coming up on Plymouth, Brockton, I think. That's not until 2017. That will probably non from AGT. I think we'll have a bit of wind generation coming up, but nothing significant, at least not in the spring months, to change the footprint. And that's pretty much it. I'll just pause for a couple of minutes, see if anybody has questions, and then get back to you. Thank you. Hi, so we're back. We have quite a few questions. So I'm not sure why cross-line cable took that long to come back. I'll have to dig in and probably email you back on that. The domestic constraint will probably have more of an upside to NEMA. The rest of the questions on the pipelines, I'll email you back shortly within half an hour. Thank you very much for attending. If you have any additional questions, please IM us and email us. And the nuclear outage, the one that we only have right now scheduled is program outage, just in case somebody missed it. Thank you so much. Bye.